For a person who does not like to make forecasts, I've been making too many forecasts, right? So here one more forecast of what is likely to happen in 2022-23 is, first, inflation will be heightened but not too high, right? So inflation will be there, but it will moderate towards the end as the shortages keep going down. Though of course we have not provided for a joker in the pack called COVID resurgence. If the COVID another wave comes and hits big parts of big countries, then that's going to be a problem. Of course, bigger problem for older countries with a higher population in the older age bracket, which means Europe and US, more than India. But yes, the whole world economy will again go back by a year or two. Second thing which is happening is the COVID has taught us that we can work from home. So companies are trying their best to woo the employee back, and the employee is just quitting, right? He's just quitting and saying, I'm joining a startup. If he's a tech guy, he's joining a startup or something, or he's doing his own startup, or he said, oh, I've created my own app, I'm earning money out of it, I will not come back. So attrition and the ability to replace them fast enough, even something like Infosys is not good at. But TCS, of course, is a big learning machine which Chandra and Ramadurai, etc. created. So it is a learning machine, so it keeps getting enough people. So TCS is perhaps at an advantage over the others. That is one. Second thing which is happening. I'm still positive on equity, and there are two ways how you can get more return. One is you put money in equities, and in the debt portion you put it in the in credit risk kind of funds. I do think credit risk and equity will give positive returns. When I say positive returns, I am saying after inflation you will still get a real return. But that may not be much, right? So because either inflation could be high or the returns could be lower. So would I take a risk in credit risk fund? I do take a risk in credit risk fund. In fact, if I put money in debt, I put it in credit risk fund and in ultra short bond fund. I don't take anything in between. But I also have a gilt fund, which is a drawdown fund, which I know it's got 17-18 years to go, so it does not really bother me. MTM does not bother me, therefore I'm in that fund. I know when I'm going to get that money, maybe when I'm 78 years of age. That's fine, perfectly all right. I want it only then, and I want it lump sum that time. So I'm doing an SIP, and I occasionally do a lump sum. So this is my portfolio, and of course I do direct equity, but I have a reasonable amount of money in equity mutual funds also. So those are all my risk assets that I am talking about. Of course there is direct equity. I bought something yesterday also, and maybe I'll buy something today also. So depending on my mood and depending on what I'm buying. So this is by and large what I'm saying. So do I expect inflation to hurt? No. But do I expect inflation to be there? Yes. But also understand that during heightened valuation times like now, chances are any policy mistake or a misstep by the government can hit equities really bad, and the credit risk funds also really bad, because the liquidity premium which is there or the illiquidity premium which is there in a credit risk fund, you may be just it may be called upon, and there may be somebody who panics and removes the money. Now if it were a close-ended fund, I would be happy, but it is an open-ended fund, you run that risk. But that's okay, I am not going to do anything about it. In fact, I may go and buy more if I see a red in that part of my portfolio. So to me, the volatility will help, but I can't say that for everybody. So if you're not very sure, then you should not be taking duration risk or a credit risk, right? It's not for you. Then your ultra short bond fund is good enough. But if you want to take risk and you understand what risk you're taking, for example, in a credit risk fund, you run the risk that one or two of the borrowers will not repay, right? You run that risk. For that risk, are you being adequately compensated? That's what you have to ask. Right now, no. But hopefully going forward, yes, that will happen as interest rates go up. What else do I want to predict? I've written something, so just let me Growth assets will do well. Yes, I've said that. Fundamental shifts will happen at the. Yeah, one more thing which I'm sure is there is going to be a lot of changes. The standard deviation will be high between getting a sector right and getting a sector wrong, and getting a country right and getting a country wrong. So internationally, I must say I'm 80% in US. Or maybe 70% in US. Have recently withdrawn some money. I have put some money in Japan. I have some money in China. But the China and Japan, I mean, there's a Japanese fund in which I have put with, and in Asia fund, the heightened presence of China can be felt. I've also put money in a Europe fund, which is as of now giving me a negative return. So not too great about it. But yeah, but I think investing in Europe is going to be tough. Especially if COVID comes back, then Europe will be in more trouble. But I still do small investments in Europe. Currently suspended by RBI, but I'm sure given a couple of months or 3, it will definitely get done. So I think the call between sectors and regions is going to be very difficult. So I am taking both sector and for regions I am putting into one fund. Which fund will choose between which sector to put and which country to put. So 2 different funds, of course. So that I think is a better option, because I don't know whether pharma will do better than banking or banking will do better than technology. I have no clue. So I would let my fund manager take that call, and I trust that fund manager to be able to take the call. The outlook for equities is still, I am broadly positive and constructive on equity funds. Only thing which in equity markets, only thing which is worrisome is the reversion to the mean. That can happen, and if that happens, it does not bother me. As I said, I may actually put more money to work. So to me, that does not matter. US will continue to do well, but in the developing markets, I think India will do reasonably well. We still have a good positive growth happening, and we have the SIPs of the retail investor coming in every month. So those things augur well for the mutual fund industry and for equity markets in India. I really don't know how much of difference is going to be there between different countries, and therefore the choice of saying, okay, I'll put in all the countries, but still I will be overweight US, because world index, it is still overweight US. I'm also looking at the Chinese market reasonably regularly, but I don't really understand too much about it, and I keep looking at the regulatory environment, and I keep looking that the market is so cruel that when a couple of businessmen go missing, nobody really misses them. Nobody says, oh, this country. And can you even imagine people who talk about ESG also look at China, where businessmen just regularly are just go underground. They're invisible. So neither is E taken care of nor is S taken care of, and G is a joke in China. But people who create funds specially for ESG funds, they also have investments in China. So do their Chinese funds comply to their ESG? Answer is no. But overweighting China may be very difficult, but for me it's the fund manager's call, right? Where will secular growth happen? Definitely in more digitization. Digitization we have seen a lot, but I think a lot more needs to be done. The Ukraine war has ensured that the Americans will sell more armaments to everybody. That's bound to happen, right? If there is a burglary in your house, your neighbors will also want to protect themselves. Maybe they'll buy guns, or maybe they'll buy lathis and join somebody who will teach them how to use the lathi. Something they will do, right? Everybody wants to protect their own property. So if you are in Houston or Texas, I mean, if you're in Texas, how do you protect yourself? You buy guns, and you go to an institute and learn how to shoot, and you keep enough guns in the house all loaded, so that in case there is an intruder, you just shoot, because you cannot afford to call the police. The police will be 40 kilometers away. Your house is far away from the police station. It's not that the police station is far away from your house. So obviously the governments will keep increasing interest rates, so cost of interest rates will go up. But if the COVID comes back, then that might be a dampener, so interest rates may not go up. And secondly, the US growth, if the US growth does not happen to be a good number, current quarter was bad, the Fed may not increase interest rates so often, so much, right? So here we are expecting 0.25 8 times a year. it may not happen at all, or it may happen 0.25 3 times a year or 2 times a year, and not really huge, because if the numbers are not good, if the growth numbers are not good, US is not going to increase interest rates. If inflation is high, they will worry about it, but I don't think inflation is going, they will live with inflation rather than live with low growth and high interest. That combination will not work. So again, these are all guesswork that I am doing. Government bonds will continue to give higher rates, which means the private sector is going to borrow money at a higher rate. Even if you borrow money abroad, you will borrow at a higher rate. The insurance costs have gone up and it will stay high. I know companies who are now saying, let us not take term insurance because we will self-insure it, which is true, because if your premium goes up 8x, last year you were paying 1 rupee, this year you're going to pay 8 rupees for it. Very, very unlikely that you will continue the insurance in that form, right? I think the dollar valuation is something on which I'm not willing to take too much of a punt, but I do think that the dollar is, if anything, it is only going to weaken. But has it weakened so far? No. So if I had put money as in dollars, I put money in the US market. So when I entered exactly 1 year ago, it was 73.8 or something like that. Now it is 76.6. Right, so if that is what is going to happen to the dollar, then any investment in dollar designated asset is going to be good for you, right? Yeah, I think I'm done. Thank you.